Hello, everyone. Thank you for joining our latest webinar. I'm Anthony Valeri, Director of Investment Management in the Wealth and Fiduciary Services Department. Today is our next update on financial markets and the economy. What we're doing our utmost to provide you our perspective on how investors should navigate the economy and financial markets amid the coronavirus pandemic. I'll take about 20 minutes to provide you our latest thoughts, and why don't we go ahead and get started. So in terms of a key summary point, the economic data, as expected, has deteriorated, with some of the reports challenging some of the weakest we've ever seen. More of that to come throughout April. The stock market, however, has rebounded very strongly after hitting a low point in March. The rebound roughly 27% before some consolidation this week. I think at this stage we'll need some more fundamental improvement via concrete signs that global economies and the economy, especially here in the U.S., can reopen effectively. That is the next step to create additional fuel for this market rally, but details are lacking on that, as I'll discuss. Coincidentally, this rebound corresponds with about the 50% retracement of the March sell-off. Historically, that's been a point of consolidation, sort of a point of resistance. Again, I think we'll need to see more details about a reopening of the U.S. economy. The collapse in oil prices has been astounding. It is historic, and that's provided another source of concerns here as investors begin to navigate or begin to deal with secondary effects of the virus. We'll likely see more of those in coming months. On a longer-term basis, we're still optimistic for the outlook for stocks, especially relative to bonds, but we do think volatile markets are likely to persist as we move from the initial impact of the virus to trying to get economies to reopen. Let me transition to economic data, and I mentioned some of these points are some of the worst on record, and jobless claims is probably the poster child for that. Been a number of weak reports, first over 6 million claims in late March, then another 5 million claims in subsequent weeks, two claims over that, two subsequent 5 million plus claims, and jobless claims have increased about 22 million in total since late March. That is a staggering number, easily eclipses the prior peaks, which you can see here on this chart, which were back in 1982 and again in 2009. So well above any precedent here, and that level of jobless claims corresponds to about a 12 to 15% unemployment rate. So we'll likely see some pretty ugly monthly jobs reports coming up. Much of this, of course, was expected, forecasted by the widespread layoffs from companies across the country, but still just showing how the data has deteriorated in the recent weeks. Retail sales is another one where we've seen a sharp pullback down over 8% in the latest reading, and this was just March, mind you, which didn't cover the full period of restrictions. Most of the restrictions started in mid-March, so you can see the decline here for a single month is worse than any we saw during the Great Financial Crisis and approaching the cumulative decline witnessed during the Great Financial Crisis. So again, one of several data points showing the extent of weakness in the U.S. economy. In China, they're slowly getting back to work. You can see a rebound in retail sales in China. If we were to look at a rebound in the manufacturing sector, it's a little bit stronger there. So China is returning to work. The activity has been slow to get back to normal, but it is happening, and it does serve as a bit of a blueprint for the global economies throughout the world to reopening. So a little bit of hope, but again, much more work needs to be done. And keep in mind, China had much more drastic social distancing and restrictions in place compared to the Western world. So I'll discuss more on that, but again, more work to do both domestically and in other Western economies before we can reopen more broadly. We are in a recession. We think that arrived in March. It's pretty clear from the economic data, and obviously the economic data that is likely to come over the coming weeks. What does a recession look like? How long does it typically last? Well, here are all the recessions going back the last 120 years, and you can see the number of months that these recessions typically last, with the Great Depression obviously the longest, with two recessions there actually back to back. I should note that event-driven shocks that you see in the economy tend to be a little more short-lived in terms of a recession. The most recent being 2001, which was set up by the tech bubble, but certainly 9/11 kind of was the further catalyst for that. So if if there is an encouraging silver lining rather to all of this, is that event-driven recessions tend to be shorter, and it's possible this could be a short 6 to 8 month recession. So just to keep in mind, if it started in March, probably looking at a recession that'll take us through the fall if it stays to that shorter time horizon. And that does have ramifications for investors. I'll talk more about that in a moment. What's really helped the market rebound and been and different than I think other crises and other recessions is just the speed and strength with which central banks have responded. This is the balance sheet of the four largest central banks. So the U.S. Fed, the European Central Bank, the Bank of Japan, and also the People's Bank of China. So some of the four big banks and how their balance sheet has expanded as they buy bonds and create other lending facilities to ease the impact of the coronavirus on local economies. This you can see the increase there of these four balance sheets, which were contracting in 2018 and part of 2019, have increased again and have increased by 2.7 trillion just in the last few weeks. To put that in perspective, that is the total dollar amount of central bank balance sheet expansion following 2008 and the financial crisis. So really a staggering and quick response from global central banks as they attempt to deal with the impacts of the virus. And I should add that on a fiscal level too, governments have been quicker than ever before to provide assistance as well. In the U.S., assistance is about 10% of GDP. That's more than the 6% of GDP witnessed in 2009 following the financial crisis. In Japan, you're seeing stimulus about 20% of GDP, and Europe is looking at additional stimulus measures as well. So a very strong response from policymakers, and I think that's a real difference maker this time and been a key driver in the stock market bouncing back from March 23 lows. Now, getting back to the stock market in terms of where we are progress-wise, this is a chart of the S&P 500 index. You'll see three horizontal lines there. The 50% represents the 50% retracement from the bottom of the rally, or the bottom of the sell-off. So 50% of the sell-off has been retraced. And again, as I mentioned at the outset, that is typically a point at which the market consolidates and awaits more fundamental news. There are two additional lines there, the 38% and call it 62% lines. Those are kind of brackets over what I think could be a trading range that develops in terms of waiting for more news on what a reopening will look like. That could frame the trading range for this environment. Again, I do think more of a fundamental catalyst is needed to push the market higher. That 58 or 50% level corresponds to about 2,800 on the S&P 500. That 38 is about a 2650, and then the 61.8% level is 2930. So that kind of gives you a range of where I think the market could go here. If it were to breach either of those to the upside or the downside, that could set a longer term trend in place. But I think that could bracket the market near term as we really wait for more meaningful news about a reopening and what that looks like. One note about the recent rebound in the stock market is that it's been relatively concentrated, and not all. Areas of all markets have benefited, stocks have benefited, but certain areas have benefited most. In the S&P 500, the top 5 companies now make up the largest share of the broad market cap than they have since the early 70s. Don't have the early 70s on this chart, but you can show that certainly since it's eclipsed the peak of 2000. And the 5 largest companies, again, you can see who they are in 2020 versus 2000. Those 5 names have been remarkably resilient and have been sort of the bigger beneficiaries of the recent rebound. As an investor, you like to see a broad-based rebound, and you like to see it in the more economically sensitive sectors of the market. And that's where I think this rally falls a little short. Some of the more defensive names have done well during this rebound. Low volatility stocks have outperformed the broader S&P 500. Again, that's sort of a defensive category. What you'd like to see is small cap stocks, emerging market stocks lead on the way out, and we're not, while they have rebounded, they've fallen short of their larger cap cousins. So not seeing the sort of risk taking that would lead to a more durable rally that could come, and it's certainly what we've seen is a good start, but would like to see more of that broadening out for the stock market rally to really continue off of the strong rebound. In the meantime, I think that's another reason why we could see more consolidation, more volatility over the near term. So a key note about the recent rally, and of course the other challenge that has come this week is the historic move in oil prices, where the price of oil went negative. In fact, closed at negative 37 one day, has since rebounded here midweek, but again, very depressed. I should note there's a lot of confusion about the move in oil prices and it going negative. And what does that mean? On the surface, that means that someone is paying to take delivery. You have to pay someone to take delivery of oil. And the reality is, in the futures market, as you roll from one contract to another, these contracts typically settle, no one really taking delivery. So the May contract and the expiration of it on Tuesday of this week really caused some gyrations. If traders are forced with a huge supply-demand imbalance in terms of contracts needing to be settled, you can get some big and exacerbated market moves. So something to keep in mind, that really sort of the supply-demand imbalance created that sort of anomaly. The June contract is trading at about $15 a barrel. So we'll go ahead, and that's something to give you a truer-eyed picture of really where the markets are and what oil is. But again, that is, give you some context around the move in oil, and I think $15 to $20 a barrel is something that is more of a true cost of oil. Keep in mind that we'll probably, because of the fact that oil is so oversupplied, we might see some more gyrations as the next contract expires in June. So keep an eye out for that. And a couple notes here on oil as we move forward. Despite the price in oil dropping so sharply, the S&P 500, or probably the S&P energy sector, shown here by the ETF price, this is ticker XLE, had rebounded from its lows, and it's still substantially above the recent lows in March. And you can see only a slight dip in response to the price of oil dipping below. So from an investment standpoint, the impact really not that great in energy stocks as they look forward, more longer term. And then in the high yield energy bond space, there was little reaction. So the average yield spread, which is a measure of risk, was relatively stable. So the average yield advantage still very high at 15% on average relative to treasuries, but still well below the peaks witnessed in late March. So the average high yield bond, energy high yield bond, really didn't react to the oil price move. So some important market notes, I think, as you take that oil price fluctuation in kind. And then let me get back to the market here. We talked about the broader market, talked about the 50% retracement. I think it's important to reiterate, and I've used this slide before, that stock markets bounce before or rebound before the end of a recession. So as we look at all prior recessions and when did the stock market ultimately bottom, on average, looking back at all the recessions since the end of World War II, stock markets have bottomed 4 months prior to the end of recession. And I had mentioned earlier, if the recession is 6 to 8 months, that would mean that bottom should come in the next 1 to 3 months, assuming the recession ends in September, October, or November of this year. Again, that's just ballparking it, but it gives you an idea that the bottom market may have already bottomed, but I think that this kind of consolidation phase might be still part of that bottoming process. But do note that it's impossible to time the market, and the market typically rebounds before the recession is actually over. So do keep that in mind. And I know one of the most widespread, this is an important point, one of the most widespread notions in the market, and we did talk about this in late March as well, is that the market typically does what's called a retest or a subsequent decline in stocks that brings it back down to the lows. That has been so widespread in recent weeks, that expectation, that the more it becomes widespread in financial media and social media, which it has, the less likely it is to occur. So for those waiting for a retest, it may not happen and we may have seen the low. While we might see some weakness, it's better just to buy on the way down for those that still have cash on the sidelines. And just to put that in perspective, if we've seen the recent rebound in stocks, if you compare the current sell-off, assuming the bottom was in March, you can look at what is the trajectory compared to other bear markets, and you can see this orange line represents the current market, the drop to the would be the end of the bear market, and then the rebound has been very, very strong. In fact, it's the strongest 15-day rebound on record, and that goes above the blue shaded area, which is the 90th percentile of rebound. So it shows you just how strong this rebound is. And the point I want to make here is when you do have this kind of a rebound in a bear market, it usually means that there is no retest in the market, that usually it moves either sideways, maybe a little lower, but there isn't that broad-based retest in the market. So an interesting point to compare the current sell-off to prior bear markets and what their trajectory has looked like 3, 6, and 9 months later. And again, here's the 15-day move that I mentioned, a historic move in over 15 days, 27% rebound over 15 days. That's the strongest such gain over a period like that. Again, if you look, and what does that mean really? And when you have such a strong rebound in a bear market, these are the best 15-day rallies. What you see is that the 1 month and 3 month returns are mixed, some positive in green, some negative in red. And if you look at the bottom, you'll see the average. And the average returns over 1 and 3 months are not too spectacular, kind of a flat-ish type market. But as you move out to 6 and 12 months, these types of rallies really bode well for strength longer term. So as we look out 6 months, as we look out 12 months, this is a pretty good guide historically for the markets on a longer term basis. And as you look out also on a 6 and 12 month basis, the final line there on the bottom, 90 and 100% of all these instances have been positive over a 6 and 12 month period. So the longer term outlook, I think, still looks bright, but given where we are in the markets, I think some consolidation, and this further kind of reiterates our expectation for a little bit of consolidation over the near term 1 to 3 month period. A key point on equities I'd like to cover is earnings season. Earnings is underway, and the reason we follow earnings closely is because ultimately stock prices are driven by corporate profits. The average annual gain in corporate profits is about 7% per year, and coincidentally that matches the stock market average gain per year since 1950. It's not about the economy, it's earnings that really drives that. The average earnings decline in a recession is about 28%. This chart shows that change historically. And on average, it's taking 2 years for the stock market to recoup the profits lost from a recession. Sometimes a little less, sometimes it's more. And that kind of gives us a baseline on when the stock market might return to prior highs. But earnings are likely to be very weak here over the next few quarters. The first quarter earnings season is already underway with the expectations that earnings will be down about 9 to 10%. I wouldn't be surprised if the number's a little weaker than that as it comes in. And by the end of this week, we should have a better gauge of the trajectory of first quarter earnings, with just over 20% of companies that will have reported by Friday. So keep an eye on, we're keeping a close eye on earnings, but again, we still expect sort of the standard decline. And if it does come back in 2 years, I think that's okay and does frame how we invest. And I'll talk more about that towards the end of the presentation. Quickly to reopening the economy. The social distancing and restrictions, as uncomfortable as they are for all of us, have worked in terms of capping the number of new case growth. In the US, it has slowed to about a 3% pace. You can see the trajectory has been a little choppy in recent weeks, and the same was true in Italy. It wasn't a straight line lower. There were periods of faster and then slower growth, but Italy's making a lot of progress with case growth there falling to 2%. But this also shows you that in the US, we have a lot of work to do. We have to bring those new cases down substantially. We're still seeing about 30,000 cases a day. You can't reopen the economy with that number of cases. It really needs to fall to zero. In China, for example, in the Wuhan region, case growth was close to zero for about 2 to 3 weeks before they reopened that region. And when they did reopen, it was a partial reopening. You had to wear a mask. Depending on where you went, you were subject to temperature checks. If you went to a Starbucks, for example, only half the tables were available to keep those social distancing measures in place. So there's a lot of work to be done, and still some questions on how strong that reopening will be. So just to keep in mind that I think this is going to be more of a long drawn-out affair as an investor. Remain patient, and again, we'll see more bouts of volatility as this uneven recovery continues. Obviously, the slower case growth is good news, but we need to see further improvement detail on reopening an economy and more work on lowering the number of new cases. Now, more on reopening. I mentioned the slowdown in case growth. It's gone to right around 3% globally in recent days. I mentioned the Wuhan region and the gradual process there. Parts of Europe reopened this week. Germany reopened on Monday with some small businesses allowed to reopen and social distancing measures still in place. Some U.S. states, South Carolina, Georgia, will reopen gradually on May 1st, but some measures and details on a reopening on a more widespread basis just really absent at this point, and it's more of a theory. So we'll need more work there. And the number of companies across the globe are working on therapeutics and a vaccine. The timeline on a vaccine is still really 12 to 18 months. And really, it's what are some of the treatments in the meantime that can help alleviate the virus. Last week, remdesivir was viewed as a drug that could potentially have some benefits, although testing still hasn't been widespread on that drug. But a number of companies continue to work on therapeutics and technologies on managing the virus. So that too will take some time, weeks to months, and will probably be a while before we get additional details there. So again, lots of uncertainty on the virus and economic impact as well as profit impact that could keep this potential rally in check and lead to more of a consolidation. And I had mentioned about a 2-year recovery in earnings. And the reason that's important is if you look at this chart, if it takes 2 years to recuperate that, and stocks get back to their February highs, that implies an annualized rate of return of 7.4%. If it happens in 1 year, that's an 11% return, obviously very attractive. However, if it takes 3 or 4 years to recoup the highs, then returns decline accordingly to 5.5% and 4.4%. I used this table the last time in our last webinar, and these numbers were higher. It was 14% for a 1 year return and an implied rate of 9% for a 2 year, which is certainly better than these numbers. And that's on one more reason why I think the market consolidates here, because the return prospects have come down and lead to more balance in the marketplace. That's okay. That 7.4 for a 2 year number is still good, especially when you consider it relative to bonds, which again, here's another one I used in the past, but I think it's worth reiterating that the outlook for bonds returns is going to be very low in the future. Bond returns track the yield of the 10-year Treasury very closely, and these are 10-year annualized returns. So where the 10-year Treasury yield is now is a good proxy for what the average return will be over the next 10 years. And if you look at the current 10-year Treasury of just below 1%, you're probably looking at roughly 1% returns on high-quality bonds. I'd probably put it in the 1 to 2% range just because of the higher yields in the corporate bond space that we are seeing now, and even in the mortgage-backed securities. So not all areas are as strong as Treasury. So 1 to 2% really the expectation, I think, when we look at longer term on high quality bonds, and that is likely to fall well short of what stocks can do over the longer term. So that'll provide some indirect exposure to equities, and why even a 7% annualized return, if that materializes over 2 years, would still be an attractive proposition longer term. So those are our latest thoughts on the markets and investing. And we're optimistic longer term on equities, but do think we're due for some volatility here over the short term. Want to thank you for joining us today. And again, please feel free to reach out to your wealth management relationship manager for more details or any questions. We're here to help. We're available to provide questions. We're all in this together as we seek to improve our investment outcomes. And we'll keep you posted with additional client letters and webinars in the future. Again, I'm Anthony Valeri. Thanks for joining and have a great day.